Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 96 on January 11th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on CEL-SCI Corporation, the S&P Oil and Gas Exploration ETF, and JD.com. Then we discuss three new trades on Volaris, Twitter, and General Motors. Now, it's always great to hear from listeners. If you guys have any questions about the trades presented here or about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. Now, I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch the videos, or find us on YouTube, our channel for the Weekly Option. The markets were back up this week. The Dow Jones Industrial Average gained 188 points, closing the week at 28,823 points. The S&P 500 index finished 30 points higher at 3,265 points. Cheers to another week of new highs. We're already starting the year off pretty strong, but certainly volatile, so keep your eyes open for sure. Now let's get into the topic of the week. The topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about this online course. Visit www.theoptionstudio.com for more information. So the topic this week is going to be limit orders versus market orders. And I received a question by email this week that was about the bid-ask spread for options and whether it was too wide at some point to trade. Now, a widened bid-ask spread can be indicative of a number of things going on in the stock or even in the volume of options that are being traded. But for this example, let's just consider how you might trade it. So this is where the different types of orders come into play when I'm looking at a market. Different orders play a huge role in executing the market. So I look first at a market order. So a market order gets you filled at the current market price. So if you are buying, you will pay the ask, and if you're selling, you will sell at the bid price, right? So because we are not market makers, we are market takers. That means that we always pay the ask and we sell the bid. So in the case where the bid-ask spread is wide, I would actually avoid using a market order because you will essentially be trading, further away from the true value of the option, and that's assuming that the midpoint of that option price is closer to real value. So in this scenario, I would actually use a limit order. I like limit orders specifically if I'm trying to get in the middle of a bid-ask spread and see if there's any room there. So a limit order actually gives the broker the instruction to place your trade at the limit price or better. You can always, execute at the limit price or better. So you can always place your trade, your limit at the midpoint of the bid-ask spread and just see if it gets executed. Now, if it's a trade you really want to enter, you might actually lose the trade. So placing a limit, if you're looking at a spread or looking at an option or even a stock and you're like, I really want into this market, placing a limit order might actually ensure that you don't get filled. You might end up missing the trade by a penny or two even, just because your order doesn't get executed. So if you really want in, if you really want to be certain that you're going to get in, but you don't mind paying a little more or selling a little cheaper, then you just use a market order. But if it's a trade that you like and only like it at a certain price, a limit order is definitely what you should use. So hopefully that helps. And I also received a question about my favorite brokerages, and I just figured I'd answer on this podcast. And just putting it out there at this point, I don't have any endorsements. I don't make any money from sending you guys to one brokerage versus the next. I like using brokerages that don't cost me a flat fee to trade options. What I mean is some brokers, many brokerages charge you a flat upfront fee, let's say $5 or $4.95, and then they still charge you a volumetric price for each option that you trade. So let's say you decide to trade a spread, they are going to charge you that $5, and then they're going to charge you a certain price for each of the options that you trade. I prefer using brokerages that don't start with that flat price. They just go straight for the volumetric side. So for a long time, I've been a fan of Interactive Broker, and I also have an account over at Tasty Works. So those are my brokerages. I don't get paid for that endorsement. But hey, if one of you guys, if you're listening and you work for those companies, reach out to me because I certainly can strike up a deal. Okay, I'm kidding. Kinda. But let's get into hey, I'm a trader. Come on. Let's get into the trades for last week, the trade review. We had two that went against me and one that worked. So I'll start with the two that I didn't like so much, and that'll be the covered call on CEL-SCI Corporation. Stock symbol C as in Charlie, V as in Victor, M as in Mike. When we looked at this trade, the stock was trading for $9.02 per share. We looked at buying that stock and selling the January 10 call at $1, hoping for a 21.95% return in 2 weeks, because this was a January trade and January options expired a week from yesterday. So CVM stock fell $1.24 per share this week. The option that we sold fell 80 cents on the week, bringing us to a net loss between the gain that we make on that option but the loss on the stock. That's a net loss of 44 cents this week on this trade. So the stock took a huge dip on the week, leaving me in a place where I would prefer to just close the trade. So if you're a true believer in this stock, like if you look and, the stock is at a point where I could make a case technically that it might bounce and come higher. But if you believe in the stock, you could certainly roll the trade to February by buying the January call option back, and then you would lock in that 80 cents gain, and then you would sell the February 10 call at 85 cents per option. So right off the bat, you'd be back in the money on the trade and give this stock a little bit more time to finish higher. But if you're not a believer in this stock, and for me, this was a short-term trade, I'm not a believer, I'm going to actually, I'd go ahead and close the trade. Our next trade last week was a credit spread. We looked at the S&P Oil and Gas E&P ETF, symbol XOP, X as in X-ray, O as in Oscar, P as in Papa. At the time, the stock was trading for $24.03 a share. I looked at selling that January 23 half put spread at 19 cents, which creates a maximum possible loss of 31 cents per spread. Now, XOP stock fell 81 cents this week, ending the week at $23.22 per share. The out-of-the-money put spread we sold is now in the money, and we can buy the spread back for 39 cents, which is a loss of 20 cents per spread. Now, since there isn't much time left in this month, there's only one more week in January trades, I would avoid selling another trade against this spread. So there just isn't enough premium in the call spreads to make it worth trading against this put spread. I'd be selling a call spread against it, and selling a lower put spread would simply be adding on to the risk of this trade. So I would honestly just close the trade. I'd walk away from this one too and consider new trades for February. Now again, there may be a February spread that is worth trading, it's worth considering, but if you do that, you're dragging this month's risk into next month. That works for some people. It's not really how I like to trade. I like to start with a trading thesis. I allow the market to either make that thesis valid or invalid, and then I make my plans according to what the market gives me, and I move on to other trades, profit or loss. And then my final trade on the week was a debit spread on JD.com, symbol J as in Juliet, D as in Delta. The stock was trading for $37.99, And we bought the January 37.5 call spread, paid 34 cents for that spread, looking at a maximum gain of 16 cents, which is a 47% return in 2 weeks. So JD stock, this is actually my winner. JD stock finished $1.12 higher this week, ending at $39.11 per share. The in-the-money call spread we bought is even more in the money. So if you were to buy the spread back right now, if you were to cross the bid-ask spread, which is to refer back to what we spoke about earlier, if I were to put a market order for both sides, I would actually receive a gain of only 3 cents. Now, of course, you guys know not to do this because this spread is going to expire being worth the full value of 50 cents in 5 days. That is where I'll get my 16 cents gain or 47% return. So 47% return in 2 weeks, pretty good. There's nothing to do here except wait for expiration on Friday. At expiration, you'll ultimately be buying and selling stock at the strikes that you bought and sold for these options. So that's buying $37 a share and selling $37.50 a share. You'll be left simply with the profit in your account, the profit that's equal to the spread value, which is 50 cents, minus what we paid for it. We paid 34 cents, so we'll be left with the 16 cents in the account. So hopefully that makes sense to everyone. I'm happy to have made at least one positive trade on the week. And now I'm going to be looking at February trades going forward. There was a while where I would look for, 1 week trades in the month that was expiring. And, I had enough of those blow up that I really don't like sharing them on the show. Sometimes I still do them in my own account. But I if I'm going to take a trade that I really think is going to be a lot riskier than usual, then I make sure that I keep it to a small amount of money. I'm not going to put myself in a scenario where I take a punt on a trade and end up losing, my hard-earned capital for it. It's a little better than a lotto ticket, but not by much. So this week on the podcast, we're going to go ahead and look at February trades. Now, February is 6 weeks away. So I don't like all of the prices. There's still a number of companies, a number of stocks that are still being quoted with wider differences between the strikes of the options. So that kind of limits which companies I actually looked at for the week. So again, I'm not going to necessarily execute on all these trades. I haven't executed on all of them, but I will be watching them to see if on Monday or Tuesday there are prices that I want to execute on. So we'll look at, starting off, of course, with the cover call, we'll look at Valaris PLC, which has stock symbol VAL, V as in Victor, A as in Alpha, L as in Lima. The stock ended this week trading for $6.23 per share. I'm looking at buying that stock and selling the February 7 call against it, collecting 40 cents for that call option. I'm hoping to make 18.78% return in 6 weeks on this trade. Now, you enter this trade by buying VAL stock for $6.23 per share and selling the February 7 call at 40 cents. This trade makes the most money if stock prices finish above $7 per share, and the break-even price on this trade is $5.83. Now, the stock purchase would require $623, and you would collect $40 for selling the option. Our next trade on the week is going to be a credit spread on Twitter, and Twitter has become a force for politics these days. And so you see it being active. It's kind of been a bit volatile, but it's been active here lately, and the prices look right so far. So Twitter Inc., symbol T as in Tango, W as in Whiskey, T as in Tango, R as in Romeo. Stock ended the week at $32.78 per share. I'm looking at selling the February 32-31 put spread at 39 cents, which can yield a maximum possible loss of 61 cents per spread. Now, you enter this trade by selling the February 32 put at $1.59 and concurrently buying the February 31 put for $1.20. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish above $32 per share. The break-even price is $31.61 per share. And in real dollars, you would receive $39 per spread that you sell, and you would have $61 at risk because it's a $1 spread, which is the equivalent of $100. Now, our final trade on the week is going to be a debit spread as usual. We're looking at General Motors, GM, symbol G as in golf, M as in Mike. The stock ended the week trading for $34.65 per share, and I'm looking at buying the February 36-35 put spread for 63 cents with a maximum gain of 37 cents per spread, or 58.73% return in 6 weeks. Now, you enter this trade by buying the February 36 put for $2.01 and selling the February 35 put at $1.38. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay below $35 per share at expiration. The break-even price on this is $35.37 per share. And in real terms, you will pay $63 to enter this spread, and your maximum gain is $37 per spread. That's it for the week. Thank you guys for listening. Thank you for writing me via email. If you have any questions, feel free to reach out. Have a great weekend and happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.